Well, good evening, Greater Harvest Global Ministries family, friends, guests, first time viewers. My name is Elder Elect Kenyatta McNeill. Thank you so much for joining us for another You Matter Wednesdays pop up. Yes, cannot believe that it is already August the 16th. We do have two more You Matter or YMW pop ups. The next one will be on September 20th, and our last one for the year is October the 18th. But don't fret, we've got some bonus content for you coming up to hold you over until YMW starts for the year of 2024. But again, thank you so much for joining us for another You Matter Wednesday pop up. This month, we will be discussing Money Matters. Yes, this is the YMW pop up for Money Matters. And since we are currently in the season of renewing our auto insurance, renewing or looking over our homeowners insurance renewals. Some people are actually in the midst of open enrollment for their employer for their year 2024 health insurance plans. If you did not know, open enrollment will begin November the 1st of this year and runs through. Typically, unless it is extended by the federal government, it runs through January 15th. But some employers start their open enrollments for their health insurance plans as early as July. So we've even had some employers and employees who have already chosen their plans for the year of 2024. But what was important for me was to give you some guidance, some help, some assistance as we go into this year of choosing during open enrollment our health insurance plans. Also, looking over our auto insurance renewals for the next 6 month period, as well as going over our homeowners insurance renewals for the next 6 month to 1 year period. So, the title of our YMW pop up for tonight is Surviving the Pandemic Pinch Part 1. Yes. I like the illustration with the man with the coin purse, and he's pinching and holding on to that penny or that coin for all it's worth. And I think that that is important for us in 2023 with all of the terms being thrown around about inflation, deflation, shrinkflation, a Circle K economy, Circle Y economy, whatever inflation, deflation, shrinkflation it is, we are all feeling the pinch, whether it is fluctuating prices at the gas pump, whether it's ever increasing prices at the grocery store, even when it comes to our own personal finance, such as our homes, our automobiles, our health care. We've even seen increases in those areas. So I honestly believe it is important that you're armed with the knowledge and the know how to be able to save as much money as possible in these seasons so that way you can maximize your income. And you're not throwing money away unnecessarily. The Bible decrees and declares that my people perish. Why? Because of a lack of knowledge. But then it goes on to say, why? Because they have rejected knowledge. And I pray that none of you on tonight would reject knowledge. Now, this may be rudimentary or elementary to some of you on tonight, but I think it's very important that we go over this now that we're going again into our open enrollment season and renewal season, that our first time viewers and even some of our younger viewers who are starting out in their careers have the education and the information armed to make wise decisions as it pertains to their money. So, our agenda for tonight is our introduction, basically who I am. We'll be going over health insurance basics, auto insurance basics, as well as homeowners insurance basics. Now, we won't be doing deep dives into these. I just want to give you the basics to help you know where to look and what to look for as you do your own personal research. Okay. So, again, about me, I am a licensed property and casualty agent producer in 33 states. That's my NPN or my national producer number. I am also a health insurance coordinator. I have been in health insurance now for almost a decade, very much more so active in the last 7 years. And so I deal with this on a day to day basis, ins and outs, assisting people with their health insurance claims, with their appeals. So I do all of that and more. So now we're going to talk about and do our introduction or our going into our scriptures for tonight. So we have two scriptures. I always like to set a foundation for whatever we are discussing. Our first scripture is Psalm 24:1, the English Standard Version, and it reads, "The earth is the Lord's and the fullness thereof, the world and those who dwell therein." Okay? So that means that everything in the earth and its fullness, it belongs to the Lord and we belong to him too. That means that our concerns concern him. The fact that we are paying exorbitant prices for automobile insurance, homeowners insurance, and healthcare, that's a concern to him too, because we belong to him and he wants us to know that that is a concern for him as well, but he also wants us to be educated. Our next scripture comes from 1 Timothy chapter 6, verses 17 through 19, again, the English Standard Version, and it reads, "As for the rich in this present age, charge them not to be haughty, nor to set their hopes on the uncertainty of riches, but on God, who richly provides us with everything to enjoy. They are to do good, to be rich in good works, to be generous and ready to share, thus storing up treasure for themselves as a good foundation for the future, so that they may take hold of that which is truly life." Very, very important scripture. This is Paul admonishing Timothy, giving direction to those who are wealthy in our society. And I think it's very important that even if you don't consider yourself per se wealthy, whether it's middle class, doesn't matter, that we all ensure that we are being good stewards over our lives, over our health, over the wealth that we do have, that we use it to be generous and to do good works here in the earth realm. All right, so tonight, first thing that we're going to go into is our health insurance basics. Okay, what you need to know. I think that's very important. This is what you need to know. Okay. Now, we're going to start with health insurance plans. We're going to talk about the different types of health insurance plans first, okay? As you see, there's four different types of health insurance plans. They're listed on your screen. There are HMOs, PPOs, EPOs, and POSs, okay? So HMO, it stands for Health Maintenance Organization. With an HMO plan, in most cases, you must see a provider or primary care physician within your network. Now, when we talk about health insurance plans, you're going to hear in network and out of network. Okay? So, your health insurance plan may provide you with the ability to see providers in network and out of network, but there's a caveat, there's a catch. If your health insurance plan allows you to see providers out of network, you will have what is called out of network benefits, which means that you will have a higher copay, a higher deductible, higher coinsurance, and higher out of pocket limit to see an out of network provider. And in some cases, depending upon if it's an employer based plan, meaning it's through your job, or you get an ACA plan, which is the Affordable Care Act through the government, there may be no provision for you to be able to see an out of network provider. So it's very important that you understand not only does your plan provide you with in network and out of network benefits or just in network, and what happens if there are no in network providers and they're only out of network for the specific ailment or health condition you have. And we'll talk about that a little later. But I just wanted to make sure you understood in network, that simply means that these are the providers that have a contract with the health plan. That means that they provide service to the health plan members at a negotiated rate. Okay. Out of network means that they do not have a contract with the health plan. Okay. So that means that they're not paid a negotiated rate. All right. It just simply means that they're out of network. You still may have out of network benefits. You're just going to pay more for those benefits if you have that type of plan. So back to our HMO. Our HMO plan, again, you must see a provider or primary care physician within your network. Now, your PCP really operates as a gatekeeper. They're responsible to referring you to other providers within your network. So, say if they send you to an endocrinologist, that's someone who deals with diabetes or hormones, they send you to an orthopedic specialist, they're going to refer you because oftentimes specialists require referrals from your PCP, and sometimes they require them from your insurance company, depending upon who your insurance is. But more often is the case than not, they require a referral from your PCP. Your PCP under an HMO is responsible for ensuring that whoever they send you to is in network or within your network. Okay. Now, next, we have what's called a PPO. That is called a preferred provider organization. Now, with a PPO plan, you have more flexibility to see the doctors that work best for you. All right. Now, more than likely, you will have to pay more for the cost of care for an out of network provider. Remember what I was talking about previously, that with some insurance plans, you can have what's called in network benefits and out of network benefits. You will predominantly see that with a PPO plan, meaning you'll have benefits if you see providers in network as well as what your benefits are, what we call your benefits and eligibility if you see an out of network provider. Now, premiums tend to be higher with this type of plan, which is commonly often paired with a deductible. Okay. Now, within health insurance plans, you will commonly hear HDHP and PPO. Like what? HDHP is a high deductible health plan. Okay. A high deductible health plan can still be a PPO. Traditional PPOs from the early 2000s, some employers still have these plans where you might have a $500 deductible. That's it. You don't pay a coinsurance, you might pay a copay. Everything is pretty much standardized across the board. But now PPOs are kind of broken down into what I call the old school PPO with the $500 deductible, maybe 1,750, to now where you have PPOs with a high deductible health plan or a high deductible PPO, which your deductible is 3,000. Your deductible is 6,000, 8,000. I've seen it as high as 12,000 depending upon the plan you choose and the employer that you may be with. That's a PPO with a high deductible. Now with PPOs, again, you have in-network and out-of-network benefits. You're not limited to seeing just an in-network provider like with an HMO. And not only that, some health plans across the board, you can see any provider within the contiguous 48 states as long as they're in network with your PPO. And that's typically indicated on your insurance card and within your benefits. Now, an EPO is called an exclusive provider organization, okay? And with an EPO plan, you don't need to have a primary care physician or referral to see a specialist. It doesn't require either. You can generally see any provider if you stay in network. That is the key. Now, with an EPO, okay, there are no out of network benefits. So, what that means is if you go to a provider outside of that EPO or exclusive provider network and you are seen, you will have to pay full price for that visit. So that potentially means that your claim, if that provider submits a claim, it could be denied. As a matter of fact, it will be denied because you went outside of your exclusive provider organization or network. So remember, with an EPO, there are no out of network benefits. Okay. You must stay within that provider organization. You must stay within that mile range because some EPOs are only exclusive to certain counties. So that means that if you're like Mecklenburg, Cabarrus County, Union County, Stanley County, something to that nature, right? You're in Forsyth County, right? You in the county surrounding. It may only allow you to seek care to with providers, or for example, you um, have Duke University as an EPO. That means that you can only see providers affiliated with Duke University. You can't go to UNC Chapel Hill for care. That's considered out of network. So very important that you understand the parameters for an EPO. And lastly, we have what's called a point of service plan. That's a combination of an HMO and a PPO. And members, they do need a referral to see a specialist. And they'll have some coverage for out of network care, but typically with a higher copay. So sometimes with a PPO, you may have, or really, I've not seen a PPO or that doesn't have it or an HMO, you have a copay to see your PCP and you have a copay to see a specialist, right? Your standard copay, we'll just say for an example, your standard copay to see your PCP might be $10, to see a specialist, it might be 50. Well, under a POS, depending upon if you see a specialist outside of that, it could double or triple. So I want you to keep that in mind. Now, let's talk about health insurance costs, okay? So we've talked about the plans, the four different types. Now we want to talk about the costs associated with those plans, okay? So I put some terminology up here for you as a visual so you can understand the costs that you are going to incur or have with a health insurance plan. And taking a look, you will have a premium. That's essentially what you pay to keep your insurance plan active, and you pay it monthly. All right. That's the way you access your plans. Some plans have higher premiums and lower deductibles, and some have lower premiums and higher deductibles. Remember when I talked about the high deductible health plan, how PPOs, you have that, what I call old school PPO with the $500 deductible, but now you've got a high deductible PPO or high deductible health plan that has a $3,000 deductible, but your premium is lower, right? Uh, Oftentimes during with employers, you typically see high deductible health plans and maybe one what I call again old school PPO being offered, and that is because high deductible health plans often come with an HSA, an HRA, or an FSA attached to them. It's a requirement. If an employer provides you with an option to get a high deductible health plan, they should also be providing you with an HSA that either they fund, you fund, or the both of you fund together to help defray or help with some of the costs involved with a high deductible health plan. Now, again, when we talk about deductible, the deductible is the amount you pay out of pocket for your care before your insurance plan starts to pick up the tab, right? So again, the higher the deductible, the lower the premium. The lower the deductible, the higher the premium that you're going to pay. So if your deductible is $3,000, what that means is you have to pay $3,000 before your insurance plan will kick in or pay any amount towards your health care. You're responsible for that. That's your PCP visits, potentially any hospital visits or surgery, potentially any x-rays, MRIs, medication. Now we're going to talk about coinsurance or copayments. It's both. It's and or, right? Some plans you may see have just coinsurance and don't have a copayment. Some plans you see, a lot of them that I see, they have coinsurance and they have a copayment, right? Coinsurance is effectively cost sharing. All right. So you've met your deductible, that's $3,000. But remember, if you notice, the last bullet on here is your out of pocket maximum. Your out of pocket maximum is the limit or the most that you will have to pay for covered services within a planned year, including your deductible and or copays coinsurance. Now, I put a note, some plans may still assess a copay even if you meet your out of pocket. All right. Now, going back to our example of the high deductible health plan. Your deductible is $3,000, but your out of pocket maximum is $6,000. What that means is this. You have paid your deductible of 3,000. You think that's it, you're over because you still have the mind of the old school health plan. Nope. No, no, no. Wait, stop. You've only paid half of what you're required to pay, okay, for your care for an entire year. So you still have another $3,000 to meet. Now, with an out of pocket maximum, this is where your cost sharing and your copayments come in, or coinsurance. All right. Coinsurance, cost sharing is one and the same. Some people will say cost sharing, or you'll see it in some literature. Some people will say coinsurance. So you have a $3,000 deductible. Say your employer benefit plan says you have a 10% coinsurance, and then you have a $6,000 out of pocket. What that means, saying it across the board, is that the first $3,000 is your responsibility, right? 10% coinsurance means that you will pay 10% of any charges that are allowed, okay? Your insurance company will pick up the remaining 90% for the remaining $3,000 left for your care for the rest of the year. So you've paid the 3,000. Now you have a $500 MRI. Okay. I'm just using straight terms. I'm not even getting into negotiated rates, allowed amounts, billed amounts. Okay. So you get an explanation of benefits after you've met your deductible that says the MRI was $500. Your responsibility is $50. Your insurance company will pay, right, the other 450. And it's going to go like this until that remaining $3,000 is met for the year. Now, after that remaining $3,000 is met, all of your health care charges thereafter in network are going to be covered at 100%, depending on the insurance plan that you have, 100% of the allowed amount, because remember, an in network provider has a contract with your health insurance plan. So that means that they can bill whatever they want to bill, but because they have a negotiated rate, there is an allowed amount, meaning that that is the most that the health insurance plan will pay your in network provider, right, for that service that you received. Okay. Now, as I talked about high deductible health plans and having an HSA, an HRA, or an FSA account, I really believe that it is vital that if you work for an employer and if you don't, and you're able to secure an HSA, an FSA, or an HRA, I would highly advise that you do. Now, an HSA is a health spending account. That's the acronym for HSA. An FSA is a flexible spending account, and an HRA is a health reimbursement account. All right. An HSA is where you put money away pre-tax, and it's for you to pay for standard medical expenses. You can also pay for first aid, you can pay for sunscreen, you can pay for allergy medicine, you can pay for certain supplements. majority prenatal. You can pay for women's sanitary products. There is a whole list, a whole host of things with that you can pay for, which an HSA, dental work, glasses, frames, lens, contacts. Um, do research in your own time and you'll see what you can use your HSA account for to pay for. Now, again, an HSA, your employer can contribute. You can also contribute. There are maximums allowed by the government. They may change from year to year that can be contributed into your HSA. There's a maximum that you're allowed to roll over if you don't use all of the funds. There's a maximum you're allowed to roll over from year to year. With a health reimbursement account, okay, that is, again, it's similar to an HSA, but the contributions can only be made by your employer. Now, with an HSA, the both of you can make them. And if you leave the company, that money belongs to you even when you leave. Okay. But with an HRA, any unused funds still belong to the employer even after you leave the company. So remember that. HSA, if you leave, the money's yours. HRA, if you leave because they're the only ones that can contribute, makes sense, right? The money belongs to them. Now, with a um, FSA or flexible spending account, right? It allows you to set aside money before it's taxed and it helps you to pay for qualified, again, medical, dental, and vision care expenses. It's a little bit more stringent because FSAs typically is use it or you lose it by December the 31st. If you don't use the money in your FSA by December 31st, it's gone. You start over January 1. And all of these are attached to, for the most part, high deductible health plans, specifically HSAs, or more than likely you'll see with a high deductible PPO or high deductible health plan, you will see an HSA attached to help offset some of the costs. All right. Now, how do you save? Glad you asked. There's awesome ways that you can save on your health insurance. Definitely take a screenshot. Certainly, um, when you take the screenshot, go back in your own time and research this on your own health carrier's website so you'll have an understanding of how you can save on your health care. So, first thing is estimate your health care costs. Use your tools. All of the healthcare carriers by now on their websites should have what's called estimate a cost. Okay. That means you go to that website, right? And say you say, I have to have an MRI. Depending on the health carrier and how complex or savvy their website is, it will give you an estimate of what that procedure will cost at different area hospitals or facilities within a so many mile radius of you. You can take the filters and change them if you desire, and it'll tell you, hey, okay, uh, if I go here, it's going to cost me 50, but if I go here, it's going to cost me 125. Now, the estimates are based upon claims information that the health carrier has received in from members who have received the exact same services at these particular facilities or physicians. So it's an estimate, basically an average or an estimate of what it costs, so it gives you an idea of if you go to this particular provider in network, this is what this MRI is going to cost you. Okay. Again, you can also estimate, I think it's gotten to the point now where they've gotten it really finite as far as um, different things you can estimate or get an actual cost. I believe by January 2024, they're all due to make sure that they have an actual cost listed for a specific procedure on their website as well, or as in addition to an estimate. Now, choose network providers. This is so very important. Again, this is where your health carrier's customer service or your health carrier's website is going to come into uh, into play for you. Okay, you want to ensure that you choose providers that are in network with your plan. If you have a PPO and you don't want to use an out of, and you're not sure whether the provider that maybe your doctor referred you to, because a lot of times, again, with a PPO, the doctor's not checking to see whether or not the providers in network. They just know that they're very good, specialists in their field, and that's who they're sending you to. Even down to lab work, you want to make sure that wherever they're sending you to get lab work done, that they are in network. I cannot tell you the times that I have seen people be blindsided when they go to get lab work done and find out that because the lab was not in network with their plan, they're now on the hook for five, seven, 800, $1,000 worth of lab work because they went out of network and they weren't aware. They just assumed that because their doctor was in network, that their doctor was going to send them to an in-network lab. Again, they're not an HMO, they're a PPO. Okay. Understand your prescription medication benefit. Notice I have that highlighted. It is vital. It is important before you choose a plan that you understand how your prescription medications are going to be treated under that plan. Okay? Typically under a old school PPO, and even under a high deductible health plan that is a PPO, you have tiers. Tier 1, Tier 2, Tier 3 goes up to 5 tiers. Typically, Tier 5 and 4 are your most expensive medications. Those are brand names. Tier 1, Tier 2 is typically generic, right? And you pay a set price for that medication based upon the tier. Now, you want to make sure that your prescription medication is on a list called a formulary. A formulary is basically what the health insurance plan and the pharmacy benefit manager, basically the person that is the middleman between the pharmacy and the plan, trying not to get too technical for you, have said that this is what this medication, this is what formulary this medication falls into. And it may be that the medication that you take is no longer on the formulary, which means that you now have to get what's called a prior authorization for the medication. Your doctor has to submit a prior authorization, and you have to wait on the pharmacy plan to approve it in order for you to receive it. Give you a really good example. Wegovy. It is a weight loss medication. It was at one time covered under a lot of health insurance plans. Now, unless the employer, and again, I'm talking about if you're on an employer based plan, unless the employer opts to cover that medication, it's not covered. It's no longer covered and it will be denied if you try to get it filled at a pharmacy. So you can submit a prior authorization, and that's what I'm talking about formulary, to see if the insurance company would be willing to pay for the medication. But again, there's no guarantee that they will because, again, it's considered a weight loss medication. There are specific medications that aren't on formulary that you're required to get a prior authorization for. If you choose to get a brand name over a generic, you could be assessed a penalty by your health insurance carrier because you chose to get a brand name over the generic. If your doctor writes your prescription saying that you can only get the brand name, you are going to be charged more for that prescription because the doctor said dispense it as written or fill this with the brand name only, and you weren't aware, and you're trying to figure out why you're having to pay $500 for a 30-day supply of medication when there's a generic for $10 for a 30-day supply. That's because of how the prescription may have been written. Okay, I'm helping you on today. I want you to understand so you're not um, in the dark concerning your prescriptions. Always make sure when you're choosing a health plan that your medications are covered. Also, make sure that depending upon the health plan that you choose, whoever your employer is, you may be required under your health plan to get all of your maintenance medications. Those are the medications you take on a daily basis. You might be a diabetic, you might be an asthmatic, you might have a chronic condition that requires you to take certain medication every day, you may be required to get that medication through mail order. Okay, you can't go to a Walgreens or a CVS. You may be required to go to only Walgreens or only CVS. So what happens if you live in a small town? I'll give you an example. My oldest daughter goes to school in a small town that does not contain a Walgreens. It only contains CVS. So she has to be very careful when she starts her career in looking at health insurance plans if she decides to remain in that area, as to, hey, okay, they're saying I can only get my prescriptions filled at Walgreens. I can't get them filled at CVS. Well, her only other option at this point would be mail order. Now, if all of her prescriptions aren't able to be filled through mail order, well, what's my next option? These are all things that you have to think about to save you money because prescription drug prices are extremely high. Okay. Also, with your prescription drug or medication benefit, remember when I talked about your high deductible health plan and your old school PPO and your tiers, under a lot of high deductible health plans, prescription medication benefits are integrated with your medical. It's called integrated. What that means is your prescription drugs and your medical insurance, are integrated, meaning that you're going to pay full price for that medication until you meet your deductible. So if your deductible is $6,000, that means that whatever medications that you're on that high deductible health plan, you're going to pay full price for until your deductible is met and you cross over into the cost sharing phase when it then becomes 10%, 90%. Okay? I'm only giving you a little kind of synopsis or briefing on prescription medication, but these are things I want you to think about going forward. Definitely stay on track with your yearly doctor visits, preventative care. Under the ACA, there are a myriad of things that are covered for free, regardless of whether you've met your deductible or not. Your yearly healthcare visit, mammograms, gynecological visits, your colon cancer screenings, immunizations, well child check visits, tobacco cessation. You definitely want to know under the ACA, again, the Affordable Care Act preventative care guidelines, what is covered without you having to meet your deductible. So you can take care of getting your preventative screenings yearly. Now, I will say with colon cancer, that's typically every 3 years, unless you have a family history of colon cancer that may allow for that colon cancer screening, or the Cologuard, because there's two different things, to be covered once a year. But certainly, definitely do your research when it comes to what you are able to have done under the ACA Preventative Care Guide, so you can get your screenings and not have to pay. Now, again, choose where to get care with care. So very, very important. You want to ensure that whoever um, you get care from, what did I say? They're in network. Also, check their ratings. Um, healthcare providers and healthcare facilities, they are rated. They have star ratings. You'll see it on your healthcare carrier's website. You may see it on Google. Not only that, some healthcare plans, if that center is considered or that facility, say for instance, is a top-notch facility, or it has some type of rating, if you go to that facility, you may get a discount of 10 to 25% because you went to that facility and got your surgery or got your care. Okay, so make sure you're researching and looking on your healthcare provider's website to see if there is an option for that. Read your policy front to back. Just please don't sign up for your policy during annual enrollment and not have read your policy. Don't wait till something happens or something goes down or you get a claim for $100 and some odd thousand dollars that's denied to read your policy. You need to know your rights. You need to know what's covered and not covered. And you need to ask questions. So if you have something in your policy that you don't understand, and say, for example, you got your policy on your own, it was standalone, you didn't get it through an employer, then you go to that insurance agent. You call that insurance company. If you got it through your employer, they have a benefits manager at your place of employment. You can call the healthcare carrier and speak to a customer service representative. But as always, you want to make sure that whoever you speak to, okay, whoever you speak to, get their name, the date you called, and the time you called. So, example, you called Scooby Doo Health Insurance on today at 5:45 and asked if Dr. Shaggy was in network. And they said, yes, Dr. Shaggy was in network. You go to their website, you print it out. It shows that Dr. Shaggy was in network. But what the healthcare representative didn't know apparently, and what or should have known, and what the website didn't clear up, was that Dr. Shaggy's contract was terminated 7 days ago. So the website hadn't updated, and the representative that you spoke to didn't know. You go to Dr. Shaggy 7 days later, 2 weeks later, and you get a claim saying denied, and you get hit with a claim for $1,500 for seeing Dr. Shaggy saying he is no longer in network. Well, that's not your fault. The website wasn't updated. The representative that you spoke to gave you erroneous information. So now what has to happen is the health insurance company has to go back in, approve that claim as if Dr. Shaggy was in network, and pay it at the in network rate. But it is important that you know your rights. Okay? As I said, check if your health insurance carrier offers discounts based on the facility you choose to get care. Research the discounts are offered, okay, for gym memberships, losing weight, participating in diabetes, asthma, or smoking programs. Some health insurance carriers have uh, these different types of discount programs attached to the health insurance that allows you to get discounts on gym memberships, on weight loss programs, participating in diabetes, asthma, or smoking management programs. Like if you participate in specific certain diabetes management programs, they'll send you the monitor and the strips for free as long as you're part of the program. If you have high blood pressure, they'll send you the high blood pressure cuff, and you just are responsible for tracking on an app every day on your phone. You're just responsible for tracking your blood sugars and tracking your high blood pressure daily, on a daily basis. And being parts of those programs, they will continue to supply you with whatever supplies you may need. All right. Also, like I said, consider using an FSA, HSA, or HRA to help with paying for medical costs. If your employer offers you an FSA, an HSA, or an HRA, we went over the different types and what they are, please take it. Even though you may not be able to contribute the maximum, if your employer is at least contributing to that FSA or that HSA or HRA, go ahead and get that reimbursement account. Okay. I guarantee you, you'll be glad you did in the end. All right. Now, putting on my property and casualty hat, we're going into auto insurance basics. Okay. We want to go into some basics regarding auto insurance and what you need to know. So, I want to go over 12 facts regarding automobile insurance. All right. 12 facts. The first one. This is the one that makes people the most angry, and I can understand why. Okay. Your credit score affects your rates more than you think. Yes, your credit score does play a part in how much you pay for car insurance. It does. Ever since the automobile insurance industry was allowed to use credit scores as a determining factor in charging you what they'll charge you for insurance, they have used it to their advantage. Okay. Now, there are some states that have placed a moratorium on it, meaning that they have they do not allow automobile insurance companies to use your credit score as a factor in determining how much you'll pay for auto insurance. So what the automobile insurance industry did was they said, okay, fine. If we can't use your credit score, we'll use other things, okay, to determine how much you pay. So we'll use the make and model of your car, which that does play a role in it anyway. We'll use the area. So they have an algorithm, a system that they use to still try and maximize their earnings, even in those states that do no longer allow them to use credit scores as a determining factor for how much you pay. And what has happened is in those states is that people who had very great or excellent credit scores, right, who found themselves under this moratorium and were paying extremely low credit score or paying extremely low automobile insurance premiums, then found themselves now paying just as much as, if not more, as somebody who had a poor credit score. So you can see why that has caused some fury and some uproar in some of these states. Fact number two, insurance rates vary by state. Okay, they do. It's just a fact. Um, where you drive often is just as important as how you drive when it comes to determining how much you pay for car insurance. All right. They're going to charge you more to cover you in areas with high rates of vehicle theft, accidents, or natural disasters. If you live in a state that's prone to flooding, okay, you live in an area that's prone to flooding, you're going to pay more for your car insurance than someone who stays in a state that they don't ever deal with flooding. But they might deal with wildfires. Okay. So because they deal with wildfires and the insurance companies had to pay out claims on automobiles damaged by fire from wildfires, they're going to pay more. Okay. Your age, gender, and how you drive affects how much you pay. All right. Generally, generally, if you're under 25, you pay more for you pay more for auto insurance than someone who's older and 60, right? Um, if you're a female, for example, insurers may on average charge a young male more than a young female because based upon the stats or the data, male drivers have higher accident rates. Okay. That's how that's it's called a risk assessment, a risk score. They use risk assessments and risk score in determining, you know, what you'll pay and what's the likelihood they'll have to pay a claim out because of an accident that you caused. All right. Discounts can lower your rates. They can. If you have a perfect driving record, for example, if you take a defensive driving course, now you can only take it once every so many years or sometimes once in a lifetime that you're with that particular auto insurance carrier. But if you take a defensive driving course and you get this, you pass and you get the certificate, it can lower it can lower your premium. Also, if you're a student or you're in the military, even if you bundle multiple vehicles under the same policy or add your home or renter's insurance on. They do all of that. Also, check with your insurance company as well. And this is also kind of getting into how to save. But if you have certain anti-theft devices, I don't know if you've ever noticed that when you called in to maybe do an insurance policy over the phone, the representative may have asked you, do you have low jack or do you have this on your car? And you say yes. That goes towards helping to lower your car insurance rate or premium, rate and premium. Okay. So, fact number five, collision claims are the most common type of car insurance claim. Yes, it's the most comprehensive claims or unexpected damage to your vehicle. For example, like if a tree branch falls on your car, a lightning strike it, that's less common. Bodily injury claims are the most expensive type of car insurance claim, but certainly collision claims are the most common. And that involves your car colliding with another vehicle or object. Like, say, you live in the South, you hit a deer, that's a collision because you collided with a deer. Fact number 6, your insurer typically can't just drop your policy at any time. Typically, now they have the right to cancel your policy during the first 60 days, so remember that. Um, After that, it's pretty hard for an insurance carrier to drop you unless something serious happens, meaning your license got suspended or you got a DUI or fraud. Okay. You can also get dropped if you don't pay your premiums on time, right? If your policy term expires, okay, your insurance carrier really can make the decision whether or not they want to renew you, meaning whether or not they want your money, because they look at it like this: if you become riskier for them to insure, like say you signed on. I'll give an example. I'll give a perfect example of this. Say you signed up for a new policy with them and your motor vehicle record hadn't come in at the time you signed up for that policy. Well, within that 6 months period, because even with car insurance, your automobile insurance carrier will from time to time pull your motor vehicle record just to see if you've gotten any tickets or been in any accidents or any DUIs, um, to make an assessment as to whether or not to raise your insurance rates or to drop you. And I have seen it where people came to the insurance carrier that I had been working for, and their motor vehicle record hadn't quite gotten to us, so they were assigned a rate, for example, based on their credit or based on where they lived. But when it came time to renew their auto insurance, their auto insurance rate had tripled or doubled because now we have their motor vehicle record. And so they call in hot, upset, mad, want to know why their insurance went from $400 for 6 months to now it's $1,600 for 6 months. Well, we got your motor vehicle record, and it's showing us that you have all these previous DUIs and you have this and you have that. And so, based upon that, your rates were increased because you're a risk. Again, insurance companies are averse to risk, and the riskier you are, the more likely it is you'll pay a higher premium, and the more likely it is you could potentially, if you continue in that risky behavior, to be dropped by your insurance company. All right. Fact number 7, coverage gaps, can cost you. And what do I mean by that? It means that if you, okay, have a car, you let the insurance lapse, and say you don't have insurance, you drive without insurance for like 4 months, and you then go and decide to put insurance on the car. Well, whoever you go to get insurance with now, they're going to see that there was a gap. They're going to question you about that gap. Now, if you're in the military and you're not going to be driving the car and storing the car, there's a process that you have to go through. You have to submit your orders. There's paperwork that you have to fill out. So your insurance doesn't, because you're taking insurance off because you're not going to be here and you're not going to be driving the car and it's going to be in storage. You have to attest to that. And like I said, submit your orders. That's different than someone who has a car they were with, again, Scooby Doo auto insurance. They let the policy lapse. They didn't have insurance for 3 months. They then come over here to Pokemon auto insurance, and Pikachu is like, hey, we see you don't have any haven't had any car insurance for 3 months. Can you explain that? No. Okay. Automatic increase in your premiums at least for the next 6 months to a year. All right. Fact number 8, no fault insurance doesn't mean it's not your fault. Listen to me. Yes, North Carolina is a no fault state, but no fault insurance doesn't mean it's not your fault. It matters who caused the accident with no fault insurance. It does. After the accident, each driver is responsible for their own damages and cannot sue the other driver, even if one party was at fault. So I'm going to say that again. Okay. Despite the name, It matters who caused the accident with no fault insurance. After an accident, each driver is responsible for their own damages and cannot sue the other driver even if one party was at fault. If you're found to be at fault, you'll have to pay for any damages and you may face higher premiums in the future. Remember, insurance is risk averse. They don't like risk. And even if it's considered no fault and you have to pay for your own damages, your insurance company has to pay for your own, that's going to lead to you having higher premiums in the future. I have seen people who weren't at fault according to the police report, but according to the insurance company and the insurance company algorithm, no matter how much we may dislike it or whatever was reviewed, they were still held to a degree at fault, meaning that the accident could have been avoided if they did this, their insurance premiums increased. Okay. This is something I also see a lot of. Personal items stolen from your car aren't covered by car insurance. They are not. They're covered by your homeowners or your renter's insurance. Okay. It automatically covers items like your laptop and your cell phone, even when they're in your car. So it's definitely important that if you do rent and you don't have renter's insurance, that you get renter's insurance. You find renter's insurance is not expensive. You can find rental insurance fairly inexpensive because I've had people that make the assumption that because the landlord had homeowners insurance on the house they were renting, that when the house burned down with their property in it, that the landlord was that landlord's homeowners insurance property homeowners insurance policy, excuse me, was responsible for covering the cost of their items that were lost. No, it covers the rebuilding at cost of that structure should the landlord decide to rebuild that home, but it doesn't cover your items. Your If you didn't have renter's insurance, you're out of everything that you lost. And it is more common than you think that a lot of people have that mindset, just like they believe that if something's stolen out of their car, that their automobile insurance will cover it. No, your automobile insurance will not cover it. That's up to your homeowners or your renter's insurance policy to handle. Another one that I run across too is state minimum coverage. It isn't enough. Okay. State minimum coverage isn't enough. I know that you're only required to have a certain amount of coverage in the state that you reside in, but that isn't enough if you have a major catastrophic accident where you are at fault and there are major injuries to people. That minimum coverage is not going to cover you. And what ends up happening is now you're going to be personally liable and sued, and you're going to have to pay that judgment. Okay. You have to make sure that you work with an insurance agent to find out what is an adequate amount of coverage based on where you live, based on how you drive, based on where you drive, and based on who is driving the vehicle. Is it you? Is it your child? Is it your spouse? These are all factors that are taken into consideration when you're dealing with a really good insurance agent. These are questions they're going to ask because you want to come up with the amount of coverage. You don't want to do overkill, of course, but you don't want to be under either. So please remember that state minimum coverage isn't enough if you have a major accident and you are the cause of the accident. All right. Fact number 11, you're not covered if you use your car for business. I come across this all the time. You were doing DoorDash, you ran a red light, you T-boned somebody, pizza all over the intersection. This is a true story. It's found that you were doing DoorDash, your coverage is immediately dropped. Immediately. Now you are liable. Okay. you are liable for that accident that you caused. You now have to pay not only for your own damages, you now got to pay for that person that you T-boned out your own personal assets. A lot of insurance companies offer coverage for gig workers. So if you do Uber, right? If you do Lyft, if you do DoorDash, Uber Eats, Grubhub, they offer some type of insurance plan for you if you're a gig worker. Even the gigs themselves, these come Uber, Lyft, Spark, uh, Amazon Flex, they offer insurance plans for you uh, if you're driving, as an independent contractor for them, so you're covered and you're legal. But please, please don't be out here doing Lyft or Uber Eats or DoorDash or whatever without the proper insurance. A lot of times I found people, they don't want to tell their insurance company that they do those particular side gigs because they're afraid that the insurance company is going to jack up their rate or drop them. Depending on who it is, they could if they don't offer gig worker insurance. But that's where you need to do your due diligence. Okay. That's where you need to research online, because if you call into, I'm just telling you as an agent, if you call in and say, hey, I want to know if you offer insurance for people who drive DoorDash and Lyft, and I say no, I'm required by, depending on who I work for and the company that I worked for previously, I was required to flag if you called in and asked that question so they could go in and investigate. So just FYI, do your research online. Um, find out if the gig that you work for offers insurance for you driving for them, or while you're driving, while you're on the clock for them driving, doing those delivery routes. Okay. Fact number 12: if someone borrows your car and gets in an accident, you are liable. Okay? Hear me. You are liable. Okay? You want to make sure that you understand this, that this is understood. If someone borrows your car and gets in an accident, you are liable. All right? A rule of thumb is that your coverage follows the car, not the person. That means your policy covers damage done to your car, no matter who is steering the wheel. If a friend or family member borrows your car and gets in an accident, you'll be responsible for filing a claim and you may be liable. You may be responsible for any bills. If someone will be regularly driving your car, it's recommended that you add them to your policy as a covered driver. Okay? Now, I can tell you that there are some insurance companies that run uh, certain reports to see who's living in your household. They interface with certain with certain companies to pull up who's living in your household. And if they're of driving age, or they cross-reference them with DMV and they see that they have a license, they will automatically add them to your policy. So now you've gone from paying $200 a month. You get your next month's bill and it says 500, and you calling in upset, wanting to know because we found people that were living in your house that have driver's licenses, and you didn't disclose that, and so we add them to the policy. So now you have to attest that they don't drive the vehicle, and you have to have, there's a process that you go through to have them struck from your insurance policy and not counted towards your insurance. So it's a lot involved, but you just have to remember that if you allow someone to borrow your car and they get into an accident, okay, you are liable. So how to save? Discounts, discounts, discounts. I've got that 3 times. Discounts, discounts, discounts. Okay. You want to make sure that you search for every possible discount you can find on your own. Whether you work for the state, whether you work for the county, whether you work for the federal government, you work for a health insurance plan, you are a AAA member, you are an AARP member, and they have their own insurance plans you can get through them. You want to call your insurance company and find out if they have discounts. There are discounts for students that make honor roll in college and high school. There's discounts if you, again, if you're over the age of 60, or in some insurance carriers over the age of 65. There's discounts if you, like I said, if you work for specific insurance carriers, or if you're with a particular credit union, you can get discounts on your insurance. Shop for a better rate. I say this all the time. Every 6 months, every year, at least every year, you need to be looking for a better rate. If your credit score has improved, you want to give it time to get into the system, but at least once a year, please. You need to shop for a better rate and see if you can get a better rate. That goes into review your coverages at renewal. You need to be looking at your coverages to determine if they are enough, if they're too much. You need to know if is this something really needed. I know people who found out that their 27-year-old child was still on their insurance policy as a first time or a new driver. It was never updated. The insurance company didn't update it, and they didn't catch it, and they just kept paying. And then when they one day decided they wanted to review it, they caught it. Well, we're not going to go back all those years that they were on the policy and refund you what you paid. No, they might do a courtesy, but that's why it's important that you review your coverages every time you renew. Okay. Become a safer driver. Okay. Become a safer driver. Definitely. That's something that we can all work on. Get rid of the lead foot, start turning it into a light foot, curb the road rage, you know, don't run red lights. If it says 65, do 65. Okay. Um, I'm not going to condone and say do 70, because cops can still give you tickets for going, even if you, in some towns, I don't care if you're 3 miles over the speed limit, they'll stop you and give you a ticket for that. Just make sure, even if you take the defensive driving course, like I said, that's a discount on your insurance. Bundle your policies. If you have a homeowner's insurance policy with another carrier, you may want to now look into how much of a savings you can have if you get a comparable policy or the same policy where you have your auto insurance. And if your auto insurance carrier doesn't offer homeowners insurance, it may be time for you to look into taking your auto insurance and bringing it over to your homeowners insurance carrier if they offer auto insurance, and if not, looking elsewhere and bundling and seeing how much that will save you in the long run. How you pay your premiums. A lot of insurance carriers, if you set up yourself on auto pay, you can get anywhere from a $5 to $10 a month discount on your auto insurance just for paying it, setting it up through auto pay. If you pay it 6 months in advance, some will take off anywhere from 10 to 15%, sometimes 20% if you pay all 6 months at one time. Um, Buy an insurance loved automobile. That means is there are certain vehicles that insurance companies love to insure, and you will have lower premiums if you buy it. So if you buy a Toyota Camry versus a Dodge Challenger, which I think this is the last year they're making Dodge Challengers, you're going to pay a higher insurance premium because that's a muscle car. And then there are some insurance carriers that won't insure. There are certain vehicles that insurance carriers will refuse to insure. You can't even insure them with them. You have to go elsewhere. So you want to find out Consumer Reports, um, some of the big names out there that the Insurance Institute for Highway Safety, I believe, IIHS, you want to look on these websites and you want to research what are the cars that insurance companies tend to favor with lower insurance premiums if they're on a policy. Last one, increase your deductible. If you have a loan, okay, on your vehicle, a lien holder, you might want to check with them to see how high you can go, because sometimes they govern and say if you have a lien on it, how high of a deductible you're allowed to have. And some some won't allow you to go above 500. I found that out to be true as well. But if you don't have a lien, and you're still paying full coverage, it wouldn't hurt you to increase your deductible to save you some money, because it's going to save you in the long run. It doesn't seem like it at that point, but it will save you in the long run. Okay. All right. Now we're going to get into homeowners insurance basics. All right. What you need to know as a homeowner. So we're going to go into some homeowners insurance facts. All right, to start. So fact one, not all natural disasters are covered. I think everyone is kind of um, concerned or reeling from the fact that insurance companies are pulling out of certain states. They're just like, we can't afford it. We can't afford to keep paying claims in these states. It's, you know, some insurance companies have even gone insolvent and bankrupt because of the amount of claims they've had to pay in these particular states. And it's not a situation where, per se, they were in an area that was known to have those issues before frequently, and people just kept rebuilding there. They just refused to leave. No, it was just weather. The way the weather has been, it's now brought about a lot of these cataclysmic weather events that have they have cost insurance companies way more than they necessarily took in premiums. So again, this is why reviewing your homeowner's insurance policy is very important, because, as I said, not all natural disasters are covered. Your policy, it does generally protect against losses from lightning strikes, ice damage, forest fires. You don't always automatically have insurance for every natural disaster. If you're in an area like I was talking about that's prone to events like earthquakes and floods, you might want to look into getting you might want to look into flood policy. You might want to look into, is there additional coverage that you can get for earthquakes? All right. Fact number two, you should reassess your coverage every year. And again, that's what I said. Um, you want to reassess your coverage every year, because when you buy a home, you might start doing some adding. You might do additions, renovations. You might buy new things to place in the home. And the amount of coverage that you need at closing, right, could change, and it definitely looks very different than when you've moved in and you've made the home your own and you've made certain improvements to the home. So you definitely want to speak with your insurance agent before your annual renewal and discuss. If you put a in-ground pool in the back, they need to know. Okay. If you built on another addition, if you've added an additional HVAC system, if you put in a gazebo, whatever you've added in, say you have vinyl and now you have marble floors, you want to have those discussions, because it's definitely going to impact your coverage. Okay. Fact number three, a home's location impacts its value and your premiums. Yes, it does. If you live in a city, it often costs more in terms of physical materials, labor, wages, construction costs, than it does if you live in a rural location. Okay, that's just facts. It's going to affect your value. If you stay in a high crime area versus as if you stay in the suburbs, that's going to impact its value and your homeowners and premium. Because remember, insurance companies are risk averse. They don't like risk. Okay? They really don't like risk. Fact number four, don't use the amount of coverage required by your mortgage lender. Don't do it. Okay? That's a trap. All right? The total insurable value of your home, it's not related to the amount of money you're borrowed. All right. Your mortgage lender, really, to be perfectly honest, they only care about the that you cover the amount left on your note. So it may be less than, or in some cases, more than your home's insurable replacement cost. And you also want to keep in mind that if the bank tries to require you to carry higher limits than the insurable value, that might be violating state law. I've run into that. Okay. You want to talk to your insurance agent about the method for developing the insurance value of your home. That's why you need to talk to an agent. Because again, you got to remember the mortgage lender is looking out for their interests, not yours. Always keep that in mind. Is they want to do what's in their best interest because at the end of the day, they they want their money back. Now, whether you have anything left to salvage and to rebuild and to do what's necessary, they just want to make sure that they're covered. And even on top of private mortgage insurance, but we're not going to get into that. All right. Fact number 5, you can have claims denied if you don't perform routine maintenance. This is another one I've run into. So, any losses that result from neglect and repairs of maintenance from or the maintenance from your property can cause a claim denial. hmm So, say for example, and this is an example I've used, this is something I've come across, you don't change the batteries in your smoke detector. Matter of fact, they're dead. You haven't put new batteries in that smoke detector and God knows when. A fire happens in your home and it's found that the batteries were dead in the smoke detector. The homeowner's insurance company or the insurance carrier has the right to deny your claim because that was negligence on your part. You have bushes up against your house that you never cut, right? That you never trim. And then what ends up happening is that bush, because of how it's growing, is rubbing up against the siding of your house. It then causes a hole into the side of your house, um, and moisture gets in, and it causes rot. Now, because uh, you, as the homeowner, didn't trim those bushes, and the bushes caused the wear in the siding, and now there's rot and damage to the structure. Homeowners insurance is not going to pay. Same way with your roof. If your roof, you need a new roof every decade, any 10, I think it's every 10 years, 10 to 20 years, depending on the type of roof you get. Not unless you get one of those really nice metal roofs. I salivate over those. Side note. But if you get a roof, or you need a roof and you don't get one, and you just keep the same old roof, and then what ends up happening is a hole develops in the roof, and then water gets in and it causes major damage. Homeowners insurance isn't going to cover that damage because you're neglectful as the homeowner. So I want you to remember that you as the homeowner are responsible for routine maintenance of your home. All right. So how do we save? Again, discounts, discounts, discounts. As I said, bundling. Can you bundle your automobile insurance with your homeowner's insurance? Can you get a discount because you're a teacher, because you work for the state, because you work for the county, because you work for a certain corporate organization? When you're buying a home, consider the cost of homeowners insurance. That is very important. All right. Look for private insurance if you are in a government plan. Review the limits in your policy and the value of your possessions at least once a year. Always do that. Stay with the same insurer. Believe it or not, loyalty is rewarded. Now, the longer you stay with an insurance carrier, the better your rates become. But if you see where they're taking a turn, that loyalty can be rewarded with another carrier if they see that you haven't been hopping from carrier to carrier every 6 months. Maintain a good credit record. Credit, and again, your credit score and your insurance risk score and your insurance score, they're tied. Improve your home security. Get a house alarm. Make sure you have deadbolts. Put on locking storm doors. um, trim shrubs, trim hedges, make sure that you can see. All of these are going to go towards helping you save on your homeowner's insurance policy and make your home more disaster resistant. Make sure that your windows are sound. What can you do to improve your home's ability to stand against a hurricane, a flood, a fire? These are all things, improvements that if you make them, you can call your homeowner's insurance company, provide the proof, and it will provide more often than not a discount in your premiums. Okay. Well, I hope that what I provided or the information that I provided to you on tonight was valuable, and I hope that you got something out of it. Definitely go back and watch the replay. Certainly, you can reach out to me if you have any questions. I am on Facebook. I'm on Messenger. You can also, send me a quick email. If you have any questions about surviving the pandemic pinch or any of this, you can also speak with your own agent. If you have an auto agent or homeowner's insurance agent, I would definitely advise you to sit down and speak with one. If you don't have one, locate one. And if you do, sit down and speak with your agent. I think it's very important that you stay on trend and on topic with everything that's going on in the world of insurance and how that matters to you and how it matters to each of us. Now, some more tips. Buy your home and set in auto policies from the same insurer. Don't confuse what you paid for your house with rebuilding costs. Definitely don't do that. Just because you paid $60,000 for your house, don't assume that your homeowner's insurance policy that you can get, I don't know, $80,000 and be good. You may have paid 60,000 for your house, but now you find because of inflation and because of the economy, it's now going to cost you $140,000 to rebuild your home. Okay? Raise your deductible. Notice I put it twice. Raise your deductible. Very important. If you are able to raise your deductible, do that. That is going to save you money in the long run. Okay? Again, as I said, if you have any questions, you can certainly reach out to me. Again, thank you so much for joining us on tonight. So, I want to go over a few announcements and appeals before we close. Don't forget, this Saturday, August the 19th, 2023, Pastor Vernell Melvin will be holding his MOAT session, Men on the Move Empowerment, from 5 p.m. to 7 p.m. at his home at 7786 Turnbull Road. You can reach out to him if you would like to attend. 910-678-8635. You can also call 910-988-5155. You can also email Pastor Melvin or info@greaterharvestglobal.com if you plan on attending or would like to attend. If you have a man in your life, definitely invite him to come. It's going to be very powerful, very impacting, and very powerful. This is Pastor Melvin's heartbeat, and I know that the men that are going to be there are going to have an amazing time, and they're going to be imparted into, and they're going to leave encouraged. Join us this Sunday, August the 20th, as Evangelist Tammy Fuller from Word of Life Tabernacle, awesome woman of God and awesome prophet and also an evangelist and speaker. She will be rendering the word on this upcoming Sunday. You don't want to miss it. We had an amazing time with Pastor Dr. Cammie Hunt at the Church of Cedar Creek the previous Sunday when she preached on a good understanding. And I can't wait to hear Evangelist Fuller's message. She always comes through with a powerful word from the Lord. And lastly, if this message has been a blessing to you, if any of our messages or anything that we've done as a ministry has been a blessing to you, we ask that you give on tonight. The ways to donate are listed on your screen. You can give through online at www.greaterharvestglobal.com. You can give through our Vanco mobile app, either through the Android or Google Play Store or the iPhone App Store. You can mail check or money order to P.O. Box 551, Fayetteville, North Carolina 28302. You can text to give at 1-833-291-6371. Type in your amount and press send. And lastly, you can give through Zelle. The email address for Zelle is listed on the screen that you can donate to. And we thank you so much for your liberal giving and sowing into good ground, for this is good ground. Well, thank you again, once again, for joining us on tonight on behalf of our executive pastor, Apostle Lakeisha Dunham. On behalf of our associate pastors, Vernell and Jerutha Melvin, I want to thank you so much for joining us for another You Matter Wednesday pop-up. As I stated again, I pray that you have been blessed, and I pray that you walk away empowered. And as I stated, if you have any questions, feel free to reach out to me. I'll be more than happy to help you with any questions you may have. But may the Lord bless you. May he keep you. May his face shine round about you. And may he give you much granted peace. And may you be empowered to emerge and move forward. In Jesus' name, amen. Take care and be blessed.